Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is November 25th. You have to bear with me today. I'm feeling a little under the weather, so my voice isn't what it is. Usually, I'm going to try to push through this because I think that there's some important things to talk about today. We're going to look at what's going on in the market. We're going to look at just some regular thoughts about how I look at investing and how I want to grow my wealth long term. If you're interested in seeing what I'm doing, obviously, you can join my Discord through Patreon. I'm going to be making a change to that really soon. Right now we've got my Drawbridge Trader Club available, and we also have the VIP. And I'm going to be launching a new website here in the next, hopefully, like week. It's been a long time coming, and it's going to be pretty awesome because it's going to have a few more resources. And what I'm trying to do is streamline some of the stuff that I deliver to everyone. What I want to do, from a holistic perspective of what I'm trying to do and what I've always tried to do on this channel is provide people with information that is relevant to how they might make money. What just happened? Oh, I filled a little spy call. Nothing crazy, just a little trade closing right now. I am a trader. I trade all the time. There's tons and tons of things going on. But I know that's not for everybody. There's people out there that just want to make money. They want to learn how to make smarter choices. They want to learn how maybe dividend ETFs work and things like that. And there's also managed funds. I mean, I know there's a lot of people out there that are thinking, they see how much money people can make from trading options. And they look at that from a long-term perspective and they think, okay, well, how can I do that while I have a job? And sometimes that's impossible for people to do earlier in their life. They have to wait until either they're retired, and by that point, they haven't made enough money to, they haven't had the gains that they could have had if they had started earlier. And so I have a couple partnerships available to people. And if you guys are interested in that, go to drawbridgefinance.ca, send me an email and say, hey, I'm interested in speaking to you about managed option opportunities, because they're out there. There's people out there that I have found that offer services to people, and of course they offer to everyone for a fee. But the reality is that the returns can be outsized, and it's a pretty awesome opportunity. And like everything, there's there's minimums. It's not a good fit for everybody, but at least I can introduce you to them and say, hey, if you want to contact them, let's get out there. Now, the reason I'm being a little bit elusive about it is because of the contractual agreement I have with them. The way that I'm allowed to advertise has to be through email. I actually cannot send the information on the web because I would put myself in breach of my contract. So it's interesting to have these services available, but always services are limited in that way, and what we can approach and how we can do it, and those things. So. But happy to jump on a call with anybody. If you're ever watching and thinking, oh, I want to have potential of making options return, but I want somebody else to manage it. And I can tell you, it does require that you be a global citizen. They operate all over the world, and that you need $100,000 minimum in your account. The cool thing is they do it in your account, which is awesome. So I'm not going to say much more about that. But if you're interested in managed options, reach out to me if you meet that threshold, $100,000 US minimum, and you're interested in having somebody else manage your account. And cool service. I can tell you all about it and send you an email with the info package and all that stuff. So hopefully you guys are into that and I get some emails. Let's get into what is going on in the market. That is the wrong screen. Let's not look at that screen. This is Movement Financial. Here we go. Here's what's going on in the market. We've got SPX trading up today. Now I feel like I have lots of indicators on right now. One of the indicators that I spent a great deal of time working with last weekend was this little Bollinger Band strategy. We talked about this Thursday during the live stream. We talked about it Tuesday last week as well, but there's this blue arrow that's showing on my chart. And if you notice, the last time there was a blue arrow, it showed it right here, this little blue arrow, and then there's a corresponding purple arrow that says this is the out point. And these are opportunities for when the stock hits a certain point relative to these Bollinger Bands that are being drawn. Now, I have a couple things on here. I have the VWAP strategy. So let's just turn off the VWAP here. Let's hide that one. But the VWAP session, can I hide this? That is not it. That's the one I'm trying to. So this is a Bollinger plus RSI double strategy, and this is by Chart Art. It's one of the ones that I quite like. I don't like that when you turn it on, it goes to that screen, but that's what it's doing. What that's doing is it's showing you these really wide Bollinger Bands out here, and it shows it off the VWAP. And if you note, when we go back, let's clear off some of this stuff here. It almost always trades within that wide range. So you'll see that I've had that indicator on for a very long time. Now the other one, let's just pull up. Let's talk about two different ones here. We're going to turn off Bollinger Bands. So this is the one that you see me typically running, right? And you normally see me running this. And what it does is it shows me the VWAP. It shows me when we're way above these prices. So I can kind of look at this baseline and I can say, well, this is my opportunity line. If the stock is ever trading below this, this is where my opportunity is. And one of the ones that I've added recently, just this last weekend, is this little guy. We're going to cover that, and we're going to take this one off. And this one is similar, except it's way tighter. So it shows shorter duration. It shows a tighter spread. And it also shows these indicators where there would be a buying and selling. So this is always a long strategy, and you would go in here and the potential on the trade is like this. The cool thing is it's pretty accurate. There's this last one, the last 5 trades are wins. You were in for this drawdown, which is really sucky. You were actually in a long position, but at the same time, you were making money long term with that. Okay, NQ. We're gonna look at that. I see nobody's saying anything. Let me know where you're watching from. It would be great to know. What is somebody could let me know that I'm actually working. That would be fantastic. You know, that always is good as well. Like, is my volume on? Is that all working properly? So I can't tell with volume. I can see my video, but I can't tell my volume. I wish YouTube would give me like a little volume indicator, but it doesn't. Okay, so NQ, where are we? So looking at this tighter Bollinger Band strategy, I'm going to turn the other one back on. Sorry, that's not the one. We're going to look at this. Yeah. So from the long-term perspective, we are still considerably above the VWAP, and so we're trading inside this range. Where are we headed? Who knows? We don't know. With some sort of probability, right? We could go up. You'll see the expectation would be potentially up and potentially down. And what I want to do is, thanks, Justin. Thanks for letting me know you're watching from Colorado. Appreciate it. What I want to know is, how can I make money if the market goes up, down, sideways? You know, that is how I like to make money in general. Now, we'll get into some specific trades, and if you guys have some stocks you want me to look at, just let me know in the chat window right on YouTube. But in general, the market is recovering, and the general consensus is that we may see 7,000 on the SPX by the end of the year, which is not crazy high. You know, like, this is 5 weeks away. Could we be there in 5 weeks? Absolutely. Where were we 5 weeks ago? We were, here. We're relatively flat to where we were 5 weeks ago, but this kind of move wouldn't be surprising at all if we were to move up there. Generally, we do have what's called the Santa Claus rally, where we see lots of push to the upside. Is this low built in? For sure, we don't know. What's the safe play? I would look at this level here, the 6,200. Seems way far away, but that is where I would be placing safe trades. So if I wanted to put in some profit tents that collected some money down here in this range, then I might want to do that. We can do that easily with diagonals. So let's skip over. We're talking about Russell. We looked at that. Everything's kind of recovering nicely. The VIX is 1894, still high. So I hope everybody was taking advantage of the high VIX, selling some premium in high VIX. When the VIX comes down below that 18 level, that is when we are considered below average. So we have to take opportunities when they arise. We've had lots of opportunity over the last 5 weeks, higher than normal VIX. So are we going to continue down? Likely. If the market goes up, we should see the VIX drop below 18 again. We'll see what happens. US oil's at 57.88. Downward pressure for sure. Generally, when I play oil, I don't like to play any upside risk. So this is actually an ideal time for entry. Pretty easy to set up a trade. Let's take a look at how we might trade that. Let's just pop over to Moomoo for a second. Say we wanted to do it on a stock. Say we just use something super simple like Conoco. You'll see the chart relates these companies like Conoco. They operate very similarly to the price of oil. So when the price of oil is down, the stocks are down. We're trading right now at 86.74 and we're down 0.95. What was the US oil down today? US oil is down at 175. So it's a little bit muted, but it's pretty similar. So, and it's very easy without having to play futures. So we can play the options on this. If I wanted a position on COP that made some money to the downside, what I can do is I can select, I can sell some puts here. So a put is generally a bullish position. And if we look at the curve, you'll see what happens. We have risk to the downside, but this is like something pretty typical that somebody might pick up. They might say, okay, I'm going to sell this 40-cent put. I'm collecting half a percent. I have an 85% probability of profit, and I'm collecting a 0.5% return based on risk capital. So if the max loss is 8,200, max profit is $43, and this is in a time frame of 10 days. So it's a 0.5% in 10 days. It's pretty good. Stock would have to drop to not get this full profit. The stock would have to drop another $3, which is a substantial move for something that's already near the bottom. But what we can do is we can actually make this a lot less risk and still maintain a fairly decent max profit. And what we can do with that is if we just go to the table, if we go out in time, say we go to like 142 days, let's go to April. So I'm aiming for around 150 days on this type of trade. And what I might want to do is I want to buy some puts below. And now I can buy one of them. If we do this as one, what will happen? Here's the curve. We now have a max loss of only $692 and a max profit of 139. So we actually increase the max profit and decrease the max loss, but the probability of profit is less. And the reason that it's less is because now if the market goes up, say oil goes up, now the short put is going to expire worthless, no problem, the one that we sell. If in 10 days, if the stock price is above 83, this expires worthless. The problem is that I'm paying a net debit to get into this trade. This actually costs $285 to get in. And if the stock runs up too much, then I actually own a put that is this long put has too much value, or it has not enough value to get back my 285, and this becomes a losing trade. So that's why the probability is lower. And if we zoom out, we can see, like, say Conoco went back up to $112, which was not so long ago. This trade would lose, almost the full value that I paid, $260 out of pocket. So that's not necessarily the best setup, but it is an interesting setup. So how do we change this? How do we make this better? Well, there's a few things we can do. We can shorten the duration. Say we just go way short. We go to like 17 days. what does this look like? Well, here you go. There's an interesting trade. Max loss is 283. Max profit is 63 bucks. Probability of profit's $86. These are very, very good trades to enter. I'm only getting the mid prices and marking at 9 cents. That might be the problem with this, is that I pay some commissions, I put on the trade, but I only make 9 bucks credit collected. Now, my hope would be that the stock would go down. Ideally, what would happen is stock would go down at the 83. This would expire worthless on the December 5th, and then the stock would continue down further. And I would hold this 80 put that had another week in it, and I could make some more money. So there's a bit of a you can see how easily these are adjusted, but there's a lot of pieces going on with this. One of the more simple setups than diagonals can be just to do spreads. So what if we just did this as a spread, and when we did it on December 5th, is this worth it? When we're getting a price right now of 30 cents on this. So we're collecting a little more money. Max profit is 30 bucks, but the max loss at expiration is only $270. So these are extremely lucrative types of trades if you can stomach having the gamma risk that comes with it. Now, what you can do, and some traders do this, is they just buy extra contracts of some of the puts. So if you're planning on doing multiple sizing, like say you wanted to put on this trade and you were like the type of trader that does 10 contracts at a time, well, this is where you can buy an extra one every once in a while. So you might want to sell, let's say let's do like a sell 4 and then buy 5. What does that look like? What does this look like? Well, it decreases the delta quite a bit, and the gamma. So even if there was a heavy sell-off, the loss would be a little bit less. We're still getting a decent price to open, getting about $1 for this, so $100. And max loss on this is 1,093. Max profit is kind of irrelevant because you would probably never hold it through this trough. But what would happen with this valley of death is that if the stock did sell off, you would actually get you would get out of the trade. The IV would expand and you'd be able to get out of this trade. It probably wouldn't be as bad as it's showing at 508, because what would happen is the IV would expand, and as that expands, you get a slight increase in the T0 line. You can see that happening here. If the IV contracted, it would be bad, and the IV increases. So we see that change. Diagonals, can you go over this trade, Jimmy Traders, diagonals? Jimmy, remind me of a diagonal again. It's not one that I play all the time. It's we'll take a look at it. Trying to recall just quickly. I believe the diagonal is a diagonal spread on the downside, so on the put side, and then matching that with a fly above. The issue is, for me and those trades, the trade is excellent. I love them because the setup is super smart. The issue for playing them is the constant calculation that I have to do in my account to see whether or not I'm taking my 10% profit. The way the diagonals work is you want to just get out at 10% profit. I'll set one up. We'll take a look at it. I can't remember the specifics of the DTE though to enter, if they're because who is it that's playing those? I want to say Colin Black, but that sounds wrong. Something Black, his last name is. He's a Kiwi guy. It's an interesting trade. We'll take a look at it. It's kind of similar to this. Say you wanted to do something slightly different with this. One of the things, if you're going to play downside risk, one of the things I like to do is have a little bit of potential to the upside. So my preference typically with these is to trade something slightly different than this. I'm just going to show you something on Conoco. Let me just clear this off. What if I was to sell at the money calls that were really close? Let's go back to this December 5th. You can get a lot of premium for selling an at the money call, or even let's sell some at the money calls here. And say we sold 2 of those, and then we went out in time and we bought we bought some 87.5s. These are just slightly bigger. But if we did like 3 of those, when you look at the profit curve on something like this, it's going to give you a pretty sweet profit curve. Like look at the break even on this, it's 78 bucks. If the stock goes up, you have some long deltas. Now with this, what I can do, I know that I'm going to make a decent amount of money. Like the current P&L for this is showing 10 days out. Is there earnings coming up? Man, this seems crazy priced here. Maybe there's just that much valuation in this. Do we have earnings? No, earnings have already passed. That crazy trade. Okay, but the risk is to the downside, right? And there's not a huge amount of loss on this. $1,200 total risk, 92% probability of profit. And again, sometimes we get into these sweet spots with stocks like this. You're like, this is pretty awesome. I can make a fair chunk of change on this. What if we were to add a short or a long put to this? What if we were just to buy like an 80 put? And when we look at the curve on something like this, all of a sudden we're in a situation where it's like this trade seemingly can't lose. This is potentially possible here. This is buying the 80 put, buying 3 of the 87.5 calls, and then selling some 86 calls. It really depends on what price you get into it for. But I'm going to screen grab this. These are the types of trades that I love to set up. So let's take a look. Okay. And what else are we going to look at? We're going to look at the flag and also 8 to 10. And what does he play it on? Does he play it on the Russell or SPX? And before we get to the diagonal, we're going to look at Meta just quickly, just because I have it here in the queue. And definitely Meta is one of the ones I'm looking at all the time. We'll do a quick rundown. Apple hit all-time highs earlier today. It's retreated a little bit today. TTD, the trade desk, is trading way down in its lower range. No Bollinger Band strategy. Well, there is one here. There's an indicator long and SPX. Okay, thanks. 8 to 10 days in length. Okay. And then AMD has come back down into range, thankfully. Man, that has been crazy. This was stressing me out. I had a big trade on that. I don't want it to drop too much further, but it can hang out there for a little while. ARK down a little bit today, but overall kind of recovering from its recent sell-off, but overall, kind of trending to the upside. Adobe still trending down. Amazon still trending up, but in the lower part of its range. Do we see... Yeah, I would play neutral on Amazon. Baidu, definitely some opportunity to the upside here. I think that Chinese companies have a little bit of opportunity in this current market. Chewy playing directionally to the upside with neutral plays in place. Conoco, again, you just saw me set up that trade. It's like kind of perfect timing for that potential there. Hood, I think this is a buy right now. I think we're going to see upside move on Hood, but that's just my personal opinion, obviously. I bet trading with Bitcoin way down. Why isn't everybody buying more Bitcoin? I'm not sure. Google has been absolutely stellar performer this year, but man, there's a lot of risk up there. If there's any stock you're looking for potential pullback, this is where I would be setting up diagonals. Meta, we saw this earnings report come out last week, and we saw the stock drop from 760 down to 673. We saw this just churning down, and now finally some recovery over the last 3 days. A nice potential contract with Google. So that news came out yesterday, and I am still bullish on Meta overall from these levels. Microsoft, I am bullish from these levels as well. MicroStrategy continues to sell down the threat of delisting for these stocks that are too leveraged on digital assets. So that's the concern. And QDTE down below its normal range. I'm using this opportunity to buy with extra cash. NVIDIA coming down. We're still above the VWAP. We're at the bottom portion of the Bollinger Band. This actually looks today, that does look like a hammer candle, doesn't it? We see a reversal there. We're seeing all the trading happening right at that Bollinger. Could easily spur to the upside. Oklo, not surprised when we saw this move outside of the Bollinger that we're seeing a pullback down to the bottom. Is this going to continue? We're almost at VWAP, which is 67. This is where I would that trade that I set up on Conoco, similar sort of thing. Just looking at where we are with the RSI, I would be looking to go long on Oklo. Open trading at 753, very much kind of whippy in and out of its range. This is a great little scalp if you're looking for things to scalp in and out of, because it moves quite a bit, as you can see. And then we'll look at SPY. Well, let's go look at this. Let's go look at this diagonal trade. So the SPX. SPX, if we go to the options, we go to the table, we're going to go 8 to 10 days out. So today is Tuesday. The December 5th will be the expiration Friday. So that's 10 days. What we would look to do, man, this is so hard. Usually I prep this stuff, but diagonals, I want to say there's like he builds in like 3% to the downside. So my brain is not as sharp as it usually is either because of the craziness of this cold. But let's, why is that there? Okay, let's go 67.46 times 0.97. We're going to look for a 3% drawdown. Does that sound right? 65.43. 65.43. So 65.45 would be the closest there. So we would go. So that's the 10-day. And then when is the longer one? Is it 14 days, something like that? 17 day? I really just can't remember the specifics of this trade. Let's go a week out. And then we would go 55.45. So we go down to that same sort of level. Does he play it as a calendar? I think he plays it as a diagonal. So you go like 30 points wide. 15 points wide, something like that. So what does this do? That gives us our downside. So this is the diagonal part. I'm totally guessing, but we're looking for a 3% down move in SPX and what would happen. And then what we need to do is finance the top side. So we've got a risk right now. If the stock went up to like $400, we would lose. So on the shorter duration, so on December 5th, we would build a butterfly above, and there's lots of premium above. So we're trading at 67.48. So we're going to go back to the calculator. We're going to look for that 3% move again. So we're going to clear this off. We're going to go 67.48, and then times 1.03. And correct me if I'm wrong. But 69.50 is going to be the peak of that. So 69.50, we're going to go up here. This somehow feels wrong. Doesn't look like there's enough premium in here to warrant this trade. But and then we have to build some sort of butterfly with some sort of width, and we want it to be like enough to make it worthwhile. So say we buy the 69.30, we sell the 69.50, and then we're going to be, this is one of the issues with the diagonal, right? So we have the diagonal to the downside, but now I'm limited with the number of contracts that I can put on Moomoo. I can only do 4 contracts or 4 different positions. So I have to eliminate the diagonal portion off of this. And we'll just kind of have to remember what the positions were. Then what we would do is we would go wider. So if we're $20 wide here, we'd go $40 wide on the top side, and we would take a look at that. We were going to sell 2. So this is the butterfly. And what we want, this is 88% probability of profit. We're getting 5 cents to open this. And max profit is 2,000, max loss is 1,900. So if we look at the curve, you're basically getting nothing for this. And the idea is that, you know, if you can drift into the profit tent, we can make some money. So we have this 69.30 to 69.70. I'm pretty sure that he sets it up slightly differently than this, but I'm just going off of recall. There's if you guys look at theta profits, there's a really great interview about the fly diagonal. Like, I've played it a couple times. I just don't love it. I mean, it's cash secured, which is great. So how can we make this a better trade or a different trade? Well, what I would want to do is maybe make the butterfly slightly smaller profit tent to increase the amount of money that I get. This is 38 cents. It's not very much for the amount of risk that I'm now taking. It's not that great. I would actually rather be in a position where I was making more money or I was playing it tighter. 69.60. This is from now till December 5th. So if we were to look at, that's 200 points away. If we're to look at the chart, like, well, let's go to SPX. It's not that far. Like, there's 69.50, you know, and then we're risking on the top side. And you'll know that this trade actually has most of the risk to the upside. So even if I went back to this setup where I was even, like 30 points. So I'm 20 points wide and then 40 points wide. Maybe he does 50 and 100. I'm not sure. It's a broken wing butterfly. You go out 8 to 10 days. Well, that's what I am. I'm at 10 days right now. This is the broken wing butterfly. That's exactly what we're looking at. The question is, you know, how much credit do I need to collect? Because both of these trades lose to the upside. If the market goes up, like currently we're sitting here at the market, right? It's 64.46. So you can see the T0 line, this dotted line, and this trade is a loser if it goes down. Losing, losing, losing. And if we clear this off and we look at the put diagonal, it's also a loser on that same thing. So if we go down 65, what was it, 65.45, something like that. If we sell this and we go out, this is what I can't remember. How long is the duration? Is it just a week longer? I think it's a week longer, and then it's slightly wider. So 65.45. I mean, this trade by itself is excellent. So this portion of it, but I almost rather just play this and not the butterfly, and I'll show you why. 65.45. So this one, no, that is not the right setup, because we only paid like two something. Yeah, even that's. But so on this one, there's less upside risk. But the curve is, yeah, I would need to know, sorry guys, in order for me to set this up, like the fly, and I don't have notes for it. Let me just check my notes. Let me see, fly. No, I don't have any notes on the diagonal. I know I've watched that video. I probably just wrote it down on a piece of paper, but it's a diagonal. There's very specific parameters to it. I'm pretty sure it's 3% below and 3% above. But there's an amount of credit that we collect for the opening of the butterfly, and there's the amount of credit that we collect for opening the diagonal. The problem with the butterfly is that the T0 line is going to drop off to the upside. The problem with the diagonal is it's also going to drop off to the upside. So it is a very specific type of trade. Most brokerages don't even allow us to put the trade on as a single trade. So now it becomes like I have 100 trades on. I don't need to add any trades to my arsenal that I can't track directly in my brokerage. IBKR is great. They allow me to do up to 6 legs. And even with that trade, they want me to put it on as a separate one. So I don't know why there's a glitch with that particular trade. But if I was only running that, I would maybe consider doing something like that. I would say, okay, I'm going to run this diagonal and this butterfly, and every single day I'm going to go in, I'm going to do the math on this, and I'm going to do the math on that, and I'm going to see whether or not that's going to make my money over the year. For the type of setup that it is, I'm like, you know, I think that we're better off taking a trade that has a little more potential to the downside. Let's just look at this. Like let's say we've got this 64.45. That's crazy price. Like let's go 6,500. Like this has lots of potential here, and then there's upside risk, right? So just go with a diagonal that's further out. I mean, all you have to do if you want to go long, rather than deal with those silly butterflies, the butterflies are great, but you could just go out here like 308 days, the September. You can get tons of premium for selling like a premium up here. Go bonkers. How far up can we go? We can go like 8,000. Let's sell a call at 8,000. And then go a little bit further out. And buy, let's buy the 8,000 call here. So this is going to cost like a $5,000 debit. Let's look at the curve. Now we're in a way better position. In this, like the expiration, okay, that's not quite covering enough. I would have to play with this, but doing a diagonal in this way would give me that T0 line to the upside. If the market rallied, I'd be making money. I don't want any red in this. So I would have to play with this to get it to work out perfectly. But these are the type of trades, like from a long-term standpoint, just hold a long-term contract. You've got $5,000 tied up in it. You have $5,000 of risk to the downside, but you have this profit tent down here, and it can work quite well for you. This one, if I change it to 7,500, that's how I would play it. Like, I think that doing this like weekly management and stuff, here we go. There's the trade. So 64.80 is my break even on that. I've got my profit 10 to the downside. And if it goes up, this trade can make, $700 or $600. There's no upside risk at all. So from a return on capital standpoint, the max loss $11,000. I'm super likely to make 7% on this. And if the market does rally hard, instead of it becoming a losing trade, I've got the dynamic delta to the downside in here. I've got that put, and I can spread this out as much as I want. So I can just buy a little bit tighter put, and that will, you can see how that changes that line. So I just want to find it so that I can get the lowest break even I can. 64.98 on that. And the nice thing about doing this, when you've got this like long diagonal on here, this upper spread, the 308, 388 call calendar in play at 7,500, is that you don't have to adjust it every week. All you're dealing with is tracking the diagonal now. That's the way to roll. That's what I think about these types of trades. Like, I see when people are doing these setups and they're like, oh yeah, we're going to do this. You're trying to like manage a complex trade and manage another complex trade. And if this happens and that happens, and like really what you're trying to do is, it seems a little silly to me. I mean, like, pick a direction and go for it. It's a good time to enter SPX. I think we're going to go up. This has positive theta decay. It's got a max loss built in. Like, what's the theta on that? $26 a day. I don't know. It does lose money if SPX rallies above 9,400. But man, that's got to go a long ways. And that's how I would prefer to set up a trade. Because say the trade, the diagonal, say you've got like $1,200 of risk on, and what are you trying to make? 10%. So you're trying to make $120. Well, $120 over 10 days is only $12 a day. This trade has $26 of theoretical theta decay, and it's probably a little bit better than you would expect. It's still got the diagonal to the downside. I don't know. I look at these things and I think we'll set up something long term and then just track it over time. I'm going to save this one too. I like this. Where's my button? I feel kind of ornery today. I don't know why. I like the diagonal trade. I just wish the brokers would allow us to capture it a little bit better. VP, I don't know why your message was retracted, but type it again. Unless you're trying to advertise something, then don't. But if you've got a real question, then just put it in the chat and we'll try to get that answered for you. What else is going on? I hope you guys are making money today. I mean, IWM, the Russell's up quite a bit today. We've had a bit of a drawdown overall. Everything seems to be printing. That's what I want to show you. Let's look at zero loss trades. I see this all the time. I'm in all these forums and there's a, you're going to what can I do with my account? I've got $1 million account and I want to make more than 5%. And how do I make money off of this? There we go. That's charting a little bit better on that Conoco. That's how it should have charted before. I don't know why it was charting so crazy. This makes more sense of $423 in risk and almost no risk to the upside if we could get in at mid price, but still a nice trade. I like that setup in general. So, but that chart is now loading correctly. Okay, let's look at zero loss trades. Let's see if we can set one up on Conoco. I'm just going to go to the table. I know this seems crazy, but people, if you understand butterflies and you understand how they might work, then it's relatively easy on almost any stock to set up a trade that can't lose. I'm going to show you right off the cuff how these trades set up. We're going to look at a butterfly. We're going to look at the 85, 75, and then 95. So this is a $10 wide butterfly, all calls. And then we're going to look at the curve on this. So here it is. Actually, this one may not work. It may be too wide because the max profit on this is 593, max loss is 406. We're inside of the tent. In order for this to work, we have to have a butterfly that's pretty cheap. And so maybe I've been too aggressive on this. So let's go to a tighter butterfly. What I'm looking for is low risk, high potential return. So in this case, 377 to 122. Now, these are great trades in general. The fact that we're risking like $122 to potentially make 378 is pretty awesome. Can I do it so there's absolutely no loss? Absolutely. I can take this trade, I can change this 80 call to a put, and then I can buy shares. I can just buy shares. And this requires a lot more buying power. But basically what's happening, you can see it hasn't reduced it to nothing. This is costing a debit of $80.60. Now, if anybody's ever played a married put before, the risk on the married put is that the stock drops down below our strike, and we can only recover the amount of money that we have the long put for. So when I have a long stock position, I can make money to the upside, but the risk is to the downside still. And in this case, I would be able to get back $80 from my investment. And if I paid $80.60 for this trade, I would have 60 cents of downside risk. So let's look at the curve. You can see that it's reduced the curve. It's the same butterfly, except now I have an expiration P&L of $50 instead. Now, one of the things that is going to happen is that Conoco is likely, if we go to the chart, they're probably going to pay a dividend in here. So if we look at these dividends, so May 19th, when was the last time February they paid a dividend, and then November 8th they paid a dividend. Did we just have one? November 17th. So they've already paid this, just happened a few days ago, 84 cents. So that is not relevant because before the next expiration there isn't going to be a dividend. But can we take it to completely no loss whatsoever? Yes, we can. We can just tighten up these strikes a little bit. Let's go to the 82.50 and let's go to the 87.50. We're making even, still showing. So this is costing 82.63 and guaranteed I'm going to get back at least 82.50 if the stock drops. But if it falls in the tent, then I make some more money. I'm a bit surprised that there's not a better premium here for 52 days. So let's try a different stock. It doesn't work on all stocks. Let's look at Tesla. That's one of the ones that sets up really easily on. But if you're interested in just like having positions that make money, for sure, make money. Now, I'm not guaranteeing that. I'm saying the position does. So you still have to manage it. You can't just say, oh, I didn't manage the position and then I lost money. But let's say I wanted to do the 415, 400, 430. So we're making an even butterfly, but I'm using a put, the calls, and then I'm buying stock. Buy Tesla. So this is, again, it's going to cost $39,832 at the mid price. So, and now if let's say Tesla goes to $200 a share, well, what happens? I own a long put, so I can put these shares into somebody's account and I can get paid $40,000 for it. So guaranteed, what does that work to? $160 of downside profit. So when we look at this curve, it's going to show you this is 100% probability of making money. And people ask me about like, how would I play? Like, what would I do if I was sitting in a position where I had lots of money, a $1 million account, and I didn't want any downside risk? These are the types of trades that I am starting to put on more and more, because what the potential is I lose nothing and I can make up to $1,672. Now, this is over the course of 52 days. So let's look at a minimum return. So I make minimum at expiration of 161. So let's say I set this trade up. I bought my 100 shares of Tesla, and I just did this butterfly every 2 months. Let's run the math on that. Well, if I did it every 2 months, I would make what was the expiration P&L? Expiration P&L. We're going to call it, let's just call it 150 after commissions. So let's say I make $150 every 52 days. So that is $2.88 a day. And we do that by 365. So at minimum, I make $1,052 on this trade over the course of the year. We divide that by the total cost, which would be $39,834. So $39,834. Sorry, $39,834. And we would get a return of 2.6%. That's lower than a like an SGov or bill or something like that, something that we're just making 4.5% in, and we have no risk. This also has no risk, but it's only making 2.6 if it falls outside of the butterfly. Now it could fall inside the butterfly, and especially if we set these up at good times. If we look at the chart, like if there's a consolidation range, you see how the last time the Tesla chopped around this area, and that's what it does, right? It clusters, it like moves, and then it'll chop for an area. So can we get 2 months? Can we get like a 2 month? This one had a really good, there's like, it was in there. Now this particular range isn't crazy. This is between 415 and 430. So if we look at this table, if we look at the chart again, 415 to 430, it's pretty narrow. 415 to 430. So it's from here. It's like a little narrow range there. And it's high probability that we're not going to hit that. But what if we do? What happens if we hit it? Well, there's a huge potential in this. Let's go to the option chain. Let's just calculate off the max profit is 1671. So again, I'm going to get my calculator out and we're going to look at the 1671 and we're going to divide that by that same number. So we're going to say 1671 divided by 52 days. And we're going to times that by 365. Now, they're definitely not ever going to get anywhere close to this number. Definitely, this is like we're trying to shoot for this is just the maximum. So 11,729. Well, if we divide that by the total cost on this is that 39,835 or whatever it was that we were looking at. We're 29%. So all of a sudden I'm putting on a position that at the very worst, it makes 2.6%. and it has the potential of making up to 29%. Now, it would be great if we had trades on that could make 29%, and there's plenty that can make 29% or more. I trade trades all the time that can make way more than 29% annually. But this one has no risk, zero risk, and a range between 2.6 and 29. Yeah, that's like a no-brainer to me. I like when I look at a position, and so far the ones that I played have been amazing. Like I've got a Visa trade on. Visa has actually been downtrending, and I'm up like 13.5% annually on it. I can't wait. I'm just adding more and more and more of these. It's actually one of the upgrades I'm going to do in my Discord. So I'm going to be having a whole section just on zero loss trades. And this is for people that have large accounts. So like, I want to take a portion of my account and I want to allocate it to something that can't lose. I'm totally okay playing those. You know, you can play that range. You can pick that butterfly wherever you want. Let's jump into what happens if I adjust the butterfly. So say I thought that Tesla was going to come back down. I was looking at this chart and I'm like, well, I actually think it's going to come down here and it's going to be around the 400 level again. That makes more sense to me. Well, just center it there. That's all you have to do. So instead of this one, which is centered at the put is at 400 and the center is at 415, just move these down. We know that the $15 wide makes money. We can just go to the 400 and then make the 15 wide off of this. Let's look at the curve on this. Still 159%. So you can center that butterfly wherever you like, especially on something like Tesla. So it moves around a bunch, but if you thought Tesla was going to come back down to 400, then that's where you would center the butterfly for January in hopes that it was going to be up. If it's going to go, if you want it to be up, you can do the same thing. You can just scrub these up. So, this is the cool thing about this. There's a position that on the downside makes 38 bucks, but on the upside makes 539. So if you're bullish on Tesla, here's a trade that has a different type of risk. Or maybe what you want is, can we do it on this side? You have a long stock position and you want to take some very little risk. You got 69 bucks up here. Well, that would be easy to offset with a couple of shares. I can't do that in Moomoo, but you know, the offsetting this would be simple. You would just buy like one or two extra shares, and all of a sudden you'd have no extra risk on this, because even owning two shares, if they went from today's price of 417 to 430, then you know, that's 40 bucks. Two shares would bring this break-even line up to zero. And again, like, you know, a nice little max profit. So pretty fun if you play it on the right stocks and if you play on that 2-month duration. So let's just see if we can get one here. I'm kind of liking the idea of this, just like playing the broken wing butterfly on top of it. So maybe you play here and you're like, okay, well, I think Tesla's going to go down. You've got more potential on this downside. So now if it goes down, you're making 330. Well, that's your 4% a year, 330, and you have a profit 10 above. You got some risk. You're risking 168 bucks. But the stock has to move up substantially. And if you were bullish on Tesla, that might be the exact sort of situation you're setting up. You're like, I want to make money. That's why I bought these. I think it's going to go up over time. I have this potential of making $1,800 on this trade if it goes up to the 440 level. Pretty flexible. And there's certain stocks, Amazon, Tesla, Visa. Visa is a crazy one. It's not very volatile, and I don't know why it sets up like this, but it always does. I think it partially has to do with the dividend that's in there. Okay, I can't believe we're already at an hour. It's, you know, I somehow breezed through this. Why is this better than a covered call? Why are we asking about the Frank, are you still on? I didn't see your question, but you were asking about like a covered call. in return, in terms of what that SPX trade, I think that was, I don't know when we're talking about it. Covered calls have huge risk to the downside. I mean, I'm not sure if it was about Tesla that we were talking about this or Conoco, but when you look at any covered call, let's just look at a call here. So this trade, yes, Tesla. Well, covered calls have huge risk. Look, the max loss on this trade is $165 right there. That's $165. But when you talk about a covered call, let's just sell one of these and I'll just erase everything off. Let's just look at what the risk is. And if you guys have traded long enough, you know that sell-offs happen. And this has a max loss of $39,000. So it has a max profit of $4,600. I mean, it's a much, much higher potential profit. But man, it's a much, much bigger loss. And in a downturn, when we look at a chart like Tesla, let's just pull up. Let's look on TradingView actually, because I think that the VWAP that I have on there gives us a really good indicator of where Tesla could go. And so we're trading at 417. Here's VWAP right here at 340. Here's the bottom, 210. So that's the Bollinger Band off the bottom is 210. So let's go back to, let's just see what happens to this trade if Tesla goes to 210. So here's 210. So if Tesla went to 210, which I'm not saying it's going to, I'm just saying if it did, this trade loses $18,000. And it's a $39,000 trade. So percentage-wise, especially for people that have large percentages in their account, all the covered call can make a ton of money. But man, it can lose a lot. Having a 50% drawdown or a, what does that work out to? A 45% drawdown is huge. And especially when you're in a big position, like you've got $1 million portfolio and you're thinking, oh, okay, I'm super safe. This is great. I've made all this money off Tesla. These positions are worth tons. And something happens and the stock starts to deplete and it just starts to go down and go down and go down. These can turn into huge losses. And although I'm not against covered calls at all, I think they're a great strategy. We have to be sensible about the amount of return that we can make. And relative to our portfolio. So a simple thing on this would just be to add the married put in general. We just go to this and we say, okay, well, every time I put one of these trades on, I'm going to spend, I'm going to spend $200. Well, that max loss is now $11,000 instead of $18,000. So we're definitely defending ourselves. But the max profit is still 4,400 on a covered call. It's just that the risk is skewed to one side. What I want to do is I want to set up trades that proportionately propel my account forward year over year. I don't actually care about once you get, and then we're talking about once you get to a certain value. I'm not talking about like if you're taking just looking at it from a holistic thing. It's like I have $1 million portfolio, and normally what people would do is they would say, I'm going to take 40% of that portfolio and I'm going to buy SGOV, right? SGOV. And why would we do that? So let's look at SGOV. Let's like that is a typical thing. So SGOV, 3-month treasury bond, and we can see what happens with this price action. It just goes up and then the dividend gets paid out. And if we look at the corporate actions on here, we can see we're getting dividend 34 cents, 34 cents, 36 cents, and the dividend payment date is November 3rd and then October 1st and the 9th of, so we're getting basically 35 cents every month for this position. So from over the last year, was there any special ones? Yeah, 37 cents, 41 cents. So we can see what this is. The current dividend yield on this. Does it show here? can't remember where to see it on Moomoo, but from the yield at 37 cents on $100 investment, we're going to get, where's our calculator? We're going to get 37 times 12, right? So it's going to work out to around 4.5%. 4.44 divided by whatever the price is, 100.663 we could buy it for today. So 4.4% over the course of the year. That is what people are doing. They're parking on $1 million bucks, they're parking 400,000 in that, and they're saying, on my $400,000, I know that I am going to make, you know, 17,648 bucks on this portion of my account. Well, there's other ways to allocate that money. And I think setting up those butterflies with a little bit of management that they require are opportunity for money that would normally be parked in something like escrow. That's not for the portion of our account that's building. If I want to build my account, then I play something more aggressive. The first Tesla trade was buy one put, sell two calls, and buy one longer call, right? Plus you have to own the stock or have enough to cover. That it's not having enough to cover. It doesn't work without owning the stock, because if you do it without, you have to own the stock. If you do it without owning the stock, let's pull it up again. I'll build it again for you. Because without it, it is, I'm just going to clear this off. We'll go from the beginning. It will be we're 52 days out. We're on Tesla. What's going on here? What's changed? Something's collar. Why is this on collar all of a sudden? I just want to be on custom. Okay, so let's say we want to center on the 400. So we're going to build 385, 400. That's what we think Tesla could trade around. That's our trader intuition, let's say. So I sell the calls and I buy a put and I buy the 415 call. Well, this trade has a delta. Where's our delta? Our delta of negative 100. This is the equivalent of shorting shares. So if we look at the curve, all of a sudden, if Tesla goes up, we lose as Tesla goes up. That does not function at all. So we can be delta neutral without owning the shares, but we do that by doing it as all calls. And then it's just a butterfly. This butterfly is, again, super cheap. You do not need to do much to have this trade on. You know, you don't have to own the 100 shares. Still a very, very lucrative strategy potentially. The problem is they're low probability. So this is 12% probability. And again, the max loss is little. If you did this, let's just say you hit max loss every single month for all, you did this 52, how many trades are we getting a year? You're getting 365 divided by 52, right? So 365 divided by 52, you're getting 7 trades a year and you times that by 122. So let's just say you did this butterfly all 12 times, you'd lose 856 bucks. Well, that is why these set up as free, because you can use that other money that you would normally be buying Tesla shares with to sit it in SGov, right? So this trade only costs $856 a year. And the potential profit on it is 1372 times 7. So 1370 times 7. $9,500. So you have $9,500 potential. And then the rest of the money, the other 39,000 or whatever it works out to, could sit in SGov. So 39,000 could sit there. And we could say we're going to make 0.44% on that. And that's going to make $1,700. And then we divide that, then we subtract minus the 850 bucks that this would cost us a year, this little butterfly. And we would be net profit 861. That's why these work, because we have to choose what we're doing with our money. So depending on what you're doing, you could just do that. You don't have to own the Tesla shares. You can just put on this trade every single month. You can just say, I'm going to risk 128 bucks every single month, knowing that this is coming from the proceeds of that 39,000 sitting in my SGov. So that's two different ways to set it up. Either do the call butterfly by itself and then keep the money in something that is making more than this is costing per year. This costs about 2% per year relative to the amount of buying the shares. So basically that is, it's actually a little bit less than that, isn't it? 128 times 7 divided by 39,000. Because that's what it cost about, or sorry, it's 42,000 to buy the shares today, isn't it? 41,800. So it's, yeah, it's 2%. So this costs 2%. SCOV pays at least 4.5%. Then you know you're netting 4% or 2.4% minimum, and you have the ability to potentially make some money. And again, this is for money that I would allocate to something. But some people want to see the strategy all put together. They don't want to say, oh, I'm making money over on one side and I'm not making it here. And so for those people that want to see it all together, you just buy the shares today. And then once you have them in place, then you're just rolling the butterfly continually. And the returns have been so far on Visa, and Visa doesn't move very much. Visa's great because it doesn't move. And I've traded Visa for years using like diagonals, like unicorn trades, which are fantastic because you can trade them on the weekly. The butterflies are a lot less stress because I can see all of the P&L together. I can see that here's my Visa shares that I own, and then here's my butterfly. And over time, I can kind of adjust it as I want. And then the other thing about owning shares is like, say the shares do take a dump. Well, you can get out of the covered call at that point, and then you have the potential of making some of that money back because you've paid very little to get out of your call. So you can start to swing it. And this is what people do with larger accounts. Like nobody's just, putting money into weekly trades constantly to try to manage them. What we want is long-term holdings. We want to buy something as an asset, and we want to trade on top of the asset. And that's what this strategy allows us to do. Something that is a long-term. Does that make sense? Frank, I hope that makes sense. So that's the idea is, can I buy Visa shares now that I could eventually pass on to someone for hopefully more millions than they're worth now? That would be the idea. Boy, we're having a great day. Okay, good. I'm glad that makes sense. And yeah. Because I've done it too. I've gotten smoked by covered calls. Like you think, oh, this is great. The market's going to go up and up and up and up and up and up. And then it just starts going down, down, down. Anyways, I'm starting to ramble. It is 12:10. It is lunchtime for me. You guys are fantastic. Thank you so much. I'm going to push this button that says, let's get rich together. That's what we're trying to do. So if you guys like my videos, thank you for giving me a like. I very much appreciate it. If you know somebody that's interested in seeing some of this content, please share it on Facebook. I'm not allowed to share my stuff on Facebook. It's terrible. I go to groups. I think that these videos are helpful to people. And if you find them useful, please share them and say, hey, watch this timestamp. This is where Levi explains what he's doing, because this is how I'm making money. I'm making money doing these trades. I make videos, and I don't really make a lot of money off the videos unless you guys help me out and share them, if that makes sense. Okay, you guys are great. Thank you so much. Appreciate it. Take care.